Hi, welcome. It's Mary Ellen McGonigal, Senior Managing Director of Stocks here at Simpler Trading with your Weekly Edge show for October 14th. Today, as usual, we're going to take a look at the broader markets, see where did we close for the week, and more importantly, what we can be on the lookout for potentially going forward. Also sharing with you some of the news that drove price action last week. It certainly was quite a volatile period. And then from there, viewer question of the week. And the question is all about ways that you can potentially trade this volatility that's taking shape in the broader markets. So some of the news that drove the markets to extremes last week. First up, Producer Price Index. This is a widely watched inflation metric, certainly for the Federal Reserve. And it did show that inflation is still quite high, and this did push the markets lower in the beginning of the week. Throughout the week, several Federal Reserve officials are continuing to discuss their aggressive rate hike campaign and the fact that they have no end in sight until we see inflation at least reduced from currently high levels. Semiconductor stocks were hit earlier in the week. Biden did come out with news that he is further restricting the sale of semiconductor chips from the U.S. to China, and then other factors pushed this group down further as well as the week progressed. Another even more important inflation report on Thursday, and this really caused volatility because that consumer price index came in much higher than expected as prices are continuing to increase, which in turn is pointing to very high inflation. We'll take a look at what took shape on Thursday pre and after the open and then beyond. Also on Friday, retail sales were flat and then consumer confidence rose a bit, telling us that consumers are still standing firm. They are still spending despite the super high prices. So from here, let's go ahead and take a look. Where did the markets close the week? And here we are with the daily price chart of the S&P 500. And the broader markets were, in fact, down about 1.2% for the week. But what we want to focus on here is the fact that we did hit a new this year low on the index on the open on Thursday. We dropped about 2.5% before buyers came in, to the point where we did see a rally on the day of about 2.5%, and one of the most certainly wide-ranging days that the markets have seen in a very long time. From here, we can see that today the markets dropped about 2% as news of that high CPI-related inflation sunk in. The other important metric here is the fact that these bear market rallies are generally finding resistance at this 21-day simple moving average, which again occurred this period. So subsequent to that, we are now at this new low. Let's take a look at the momentum indicators. RSI, that relative strength indicator, is still below that 50 in negative territory. And then likewise, the stochastic. So overall, our bear market downtrend remains firmly in place. From here, I'm going to share with you a bigger view, certainly longer term for the S&P 500. This is a weekly price chart, and the purpose here is to highlight again that low that we hit on Thursday, and it did in turn put us below these other prior periods in June and then more recently 2 weeks ago. And from there, we are going to need to look at a new potential area of downside support. And in fact, that will take us back to the November lows of 2020. So quite a bit of a potential drop if we see these markets continue to deteriorate. This 32.79 level is your next area of potential support. So from here, let's take a look at the S&P 500 sectors. I'm sharing with you a 2-month daily price chart view. I've added an RSI, that's a relative strength indicator, sorted these sectors in descending order. So up on this upper left quartile, these are going to be your stronger, certainly relatively stronger areas. Down on the right are your weaker sectors among the broader markets. So we can see energy is up here at the forefront. The group overall was down a little bit more than the broader markets, but you can see how it is holding in remarkably well. I'm going to share with you the price of oil as we move forward. OPEC did come out with an announcement last week that they are going to be reducing oil output, which has been keeping oil prices elevated. Unfortunately, higher oil prices also lead to higher inflation as the gas pump and filling your car becomes quite a bit more expensive. But if we look at the chart here of XLE, it is currently above each of its moving averages, its outside momentum indicators in positive territory. So really the only constructive sector ETF that is currently in place. We can also take a look at healthcare. This is XLV. This is another group that was up 1%, while the broader markets were down for the week, except for the Dow. But we want to take a look at what may be shaping up. If we can somehow remove this outside day on Thursday, we were in the throes of forming a potential double bottom before potentially heading higher. We had very similar price action back here earlier in the year where we undercut that prior low and then did experience a double bottom formation before heading higher. Of course, this was a rally period for the broader markets as well. However, healthcare does have a history of outpacing the broader markets in a bear market environment. I'll share with you specific areas as we move forward. Also, taking a look at these sectors, you want to be equally aware of those weaker areas. Certainly, we can see utility and REIT stocks remaining down and out. Utility stocks are very oversold, but we're not seeing that bounce. And even if we did, this 10-day moving average would be your next area of upside resistance. A lot of headwinds. The increase in interest rates is making it difficult for utility companies to raise capital so that they can, in turn, keep their facilities up to date. And we can see that the group overall remains in this firm downtrending period. Also, real estate, REIT stocks, another area that relies heavily on capital in order to invest in new buildings. This area is also in a very confirmed downtrend, also oversold as well. The other headwind here is with talk of a potential recession. The renting out of their commercial or apartment buildings is going to be reduced as well. But at some point, we will be on the lookout for some sort of advance out of this oversold position, but not quite ready for prime time yet. So moving on, we can take a look at some other areas in the broader markets that I did want to share with you, and that is ETFs and other areas that have been very impactful to this broader markets price action. Again, a 2-month daily price chart view, up here your stronger areas, and take a look. The yield on that 10-year treasury is now up at 4%, very elevated level. And from there, this is another reason you're seeing those high-yielding, in particular REIT and utility stocks, suffer, simply because the yield on this treasury bond is making the purchase of these bonds more attractive than going into these stocks. Another strong area continues to be the US dollar. And we can see that overall it is in an uptrending phase, a rising dollar, not constructive for the markets, and certainly for multinational companies that sell overseas, their revenues will be negatively impacted. Volatility also up here at the forefront, surprisingly tame given what we saw in the broader markets last week, but definitely elevated. VIX closed the week at 32, which is quite a bit higher than when we are in more normalized market environments. And rising volatility is another negative for the broader markets. Let's take a look at oil. And I did want to share with you that it pulled back this week, but we still closed at about that $95 per barrel level, which based and relative to historical record is still quite elevated. And we can see, I talked to you about the energy stocks and particular areas that are responding favorably because the higher price of oil, of course, helps with their growth prospects, these energy companies. As we move forward, of course, you want to be aware of these weaker areas, and here we are with semiconductors. I talked about that hit earlier in the week due to Biden's ruling, and then as the week progressed, rising interest rates that I just shared with you are a negative for these higher growth areas, semiconductors being among them. And this was one of the worst performing areas, down about 7.5% last week, further downside ahead. Likewise with software, another high growth area that underperforms in a rising rate environment. This particular industry group, this is IGV, is the ETF that I use for software, and it was down over 5% for the week. So now you have these shorter term moving averages, the 10 and the 21-day heading downward. So any rally attempts are continuing to be met with resistance at this downward trending 21-day simple moving average. So quite negative dynamics continue to take shape there. One area that is brightening just a bit, but it was up last week, is biotech, up 1%. This is one of the areas in healthcare where there are a couple of names, particularly larger names, that are outperforming the markets. And if you go back, for instance, to the 08 bear market, two names that were positive in that 08 period where the markets were down 34%. I'm going to share with you two names that were up actually more than 34% in 2008. So first up here is Amgen, and you can see this nice gap up that took place earlier in the week. This was on news of a Wall Street upgrade from Morgan Stanley. The stock is now poised to break out of this lengthy potential base breakout formation. Another stock that fared well in that horrible 08 bear market period is Biotech. It's not looking as constructive, but it is holding in well in an otherwise very dire broader market environment. So this is an area that I am keeping an eye on to see if we can see any kind of a continuation rally in these bigger, better known biotech stocks. From here, I did want to take a look at using different time frames of charts to help in this market environment if you are inclined to be an intraday trader, for instance. So I will begin by sharing with you a 15-minute price chart of the S&P 500. And what I did want to share with you is that for these intraday charts, I use a 5 and a 13 simple moving average. I also use this RSI metric and this MACD moving average, convergence, divergence. Both of them are momentum indicators. And what I want to focus on is that rally that took shape after the markets initially dropped on Thursday in response to the CPI report. So in particular, we can see this steep decline that took place, and then buyers did come in, whether it was short covering or otherwise. But what you want to pay attention to when that occurs, and I will share with you an individual stock as well with similar metrics, where you are going to be on the lookout, in this case the S&P, to break above that longer term 13 moving average. And then as you align that, you want to be on the lookout for a simultaneous uptick in that relative strength. And then your early signal is going to be this MACD moving average, convergence, divergence, black line up through the red. Let's see if we can line this up so that you can get a better sense of precisely what to be on the lookout for, whether it is a broader market index or an individual stock. So here we are, that break above the moving averages, the RSI into positive territory, and that nice MACD crossover indicating an uptrend. Now, I was doing a live trading room for Simpler on Thursday when this took shape, and advised investors to be on the lookout for to indicate that this near-term bear market rally or counter-trend rally would be potentially ending. So let's go ahead and use that very same exercise, and I will share with you quite simply the opposite. In this case, on the open, we had an initial rally on Friday, but as the day proceeded, we did see a break back below these moving averages. We had that black line down through the red and a negative RSI indicating the near-term end of that rally. So from here, I'm going to share with you an individual stock and we can walk through the same dynamics. First, I will share with you a daily price chart view. And this is Hostess Brands, really holding in remarkably well in line with some other consumer staples stocks where their products are still finding an audience despite increased pricing. So the reason I'm pointing that out is what I'm going to be sharing with you relative to using those individual stocks for potential intraday trading is it helps if the stock is in an uptrend and has had a history of outperforming the markets so that when you see that intraday reversal, it could in fact take shape. So let's go ahead and take a look at an intraday 15-minute price chart. And you can see this particular stock has a history of gapping up, pulling back, and so forth. What I did want to share with you is, again, those metrics when you see this take shape, whether it's in this stock or another name that has been able to rally in the face of a tough market, you will be on the lookout for that very same metric where we have that MACD black line up through the red indicating that this pullback is now turning into an uptrend. And then we have also the stock breaking back above the 5 and 13 moving average in line with that RSI trending upwards. So again, each bar is 15 minutes. As we move forward, we can see another occurrence here with that black line up through the red and so on. So in this case, the stock did pull back 2.5% today. So if you are inclined, you would be on the lookout for that same dynamic where the black line comes up through the red, your momentum turns positive, and the price moves up above these moving averages. So that's it for today, everyone. I hope you have an incredible weekend, and I will look for you here again next week. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.